Hello and welcome to Daily Finance Wrap. This is your daily personal finance show that's dedicated to you, our viewers, as we attempt to demystify the world of money, the world of finance for you. Daily, we discuss the top stories that directly impact your money and also bring you our host of guest experts who decode topics relating to investing, taxes, insurance, and even effective loan management. So, this is, of course, our daily show. I'm Mubina Kapasi, and it's not just a one way monologue. We get you to ask any questions to our experts. You can do so by writing in on the comment box that you see right here besides this YouTube live. So send in any questions or queries that you may have with respect to investing or your mutual fund portfolio, and we'll try and get that answered. So here's what we have lined up today on the show. Of course, as always, we'll bring you the top stories of the day, and we will also be discussing something that's dear to, well, most of the parents' hearts, and that is financial planning for your children. Most of us want to ensure that our child has a successful future and a financially secure one. So, we'll be discussing what are the first few steps to take with respect to that, and also some of the most common mistakes that parents tend to make. So, let's get kickstarted then. And here are some of our top stories at this hour. The RBI's Monetary Policy Committee meeting began today. Remember, it's a 2-day meeting that will essentially decide on what the repo rate or the interest rates in the economy should be. Now, this is called as the MPC meeting, and it will conclude on Wednesday. Why is this important for you? Well, basically, because this repo rate is used as a benchmark by banks, by financial institutions on what is the rate of interest that they will pencil in when either accepting a deposit or giving a loan. So that means this repo rate will have a direct impact on your home loan EMIs, your car loans, personal loans, or even if you have a fixed deposit. Now, what are the expectations? Well, a poll by Bloomberg says that out of the 13 economists that they have polled, only 3 expect a small rate cut of 25 basis points or 0.25%. The rest actually believe the rate will remain absolutely the same. Now, this has come in at 6.5%. That's where the rate is at currently. Any rate cut, no surprises, will be a positive for home loan borrowers. We'll be, of course, keeping you abreast as to what happens with the MPC on Wednesday, so stay tuned. The next story is that the income tax audit deadline, that is the tax audit reports that has to be submitted by entrepreneurs watching this show, is today, the 7th of October. This pertains to the financial year 2025. That's 2024, pardon me. That's 31st March 2024. Remember that the deadline was actually the 30th of September, but the Income Tax Department has provided those few extra days. So this is already an extended deadline. Very, very unlikely that this deadline is further going to be extended. What happens if you don't submit your tax audit report in time? Well, there is a penalty of 0.5% of the total sales or your turnover or gross receipts, or a flat figure of 1.5 lakh rupees, whichever of these figures is smaller. In other news, then, corporate news. Today's Economic Times has reported that the Adani Group is now looking to become the largest cement holder. Remember, this is just a report-based story yet, but they are apparently eyeing Heidelberg Cement's India unit. Remember that Adani first entered the cement business back in 2022 when they acquired Wholesome India's operations. Then they, of course, acquired a stake in Ambuja Cements and ACC. And now this acquisition of Heidelberg Cement's India unit is being eyed via Ambuja Cements, a name that's really a household one. This is supposed to be a $1.2 billion acquisition, or 10,000 crore rupees. It's a big, big development for the cement world, for corporate India as a whole. There are 2 big players right now, Adani and Ultratech Cement, and both are vying for that pole position. And in not so good news for home loan borrowers, HDFC Bank has hiked the loan interest rates by 5 basis points on 2 tenures, and these higher rates are applicable from today, that is the 7th of October 2024. So the lending rates have been increased by 50 basis points or 0.5% for those people who have a 6-month loan or those people who have a 3-year tenure. So not so great news coming in for borrowers. But without any further ado, join me in welcoming our guest for today. It's Nisreen Mamaji, she's a CFP and the founder of Money Works Financial Services. And we are here to talk about how to plan your finances for your children. Hi, Nisreen. Thank you so much for joining us right here on Daily Finance Wrap. It's a pleasure having you with us. And, I think whenever we take any financial decision, any step, the first group of people we think of is our descendants, our children, because whatever we do today, we want to leave behind something for our kids. And I'm sure most of the parents over here will agree with me. But you have to also specifically plan for your children. So let's start with that plan. What should be step one for proper financial planning for your children, assuming that parents out there have not done anything yet?
Okay, let me start by saying thank you for inviting me on the show. This is a topic that really touches my heart as well. And, it's a very interesting topic. A lot of parents do, ask me, what is the step one? How can we start planning for our child's future? And typically, the step one is taken at the child's birth itself, because we all are very highly aspirational when it comes to our children. We have the minute you know that you're having a baby in the family, you've already started planning the child's future, and everything requires obviously money and finances. So it's very important for us to, if you have a longer term and a longer time period to plan for your little one's, your bundle of joys future, it's very essential to have a longer time period, because then the power of compounding can work in your favor. Rupee cost averaging can work in your favor. So, typically, what do we want to plan for? You want to plan for your child's education. I think that's one goal that all of us do have, whether it is the graduation or the post-graduation. You also want to have some sort of an emergency fund. God forbid there's a medical emergency, or, a child will need some kind of extra resources than what your regular cash flow can provide. Then also major milestones, like you can, plan for a wedding. You might want to give a child, a home, and you might want to pay the down payment of the home, and then decide that the child will pay the future EMIs, and a general financial support, a nest egg for your child. So a financial cushion, so to speak. So once you've identified these goals, you can estimate, how much money you will need for each and every one of these goals, and also the time frame. Like if you're starting at birth, then you have about 18 years to plan for graduation. You have 21 or 22 years to plan for postgrad. You have 25 years to plan for a marriage. So these kind of general milestones and time frames should be set aside. So that will guide you in deciding how much to save and where to invest these funds. Now, typically the options will be SIPs into mutual funds, children-oriented mutual funds, NPS Vatsalya, Sukanya Samriddhi. These are some of the choices that you can definitely partake of and enjoy the fruits when the child is of the correct age.
And we'll be discussing those options in more depth. I want to talk about the most common mistakes, though, that parents tend to make. I mean, our intent is very clear, like you mentioned. It may be general financial support or education, so on and so forth. But still, sometimes, I guess, emotions also tend to get the better of us, right? That's where the whole aspect of behavioral finance too comes in. But yeah, what, according to you, are the most common mistakes parents tend to make?
Sure. So, like I mentioned earlier, delaying the investment itself. Because if you delay the investment till suppose you start planning for the child, say graduation, when the child is already 16 or 17, then, there's a missed opportunity, because you haven't benefited from the compound interest. And the power of compounding is actually typically the eighth wonder of the world. So that's very important, that don't start late, start early. As I said earlier, start from the time that the child is born. A second thing is, you somehow missed out on inflation also. So today, suppose the cost of a particular education that you have planned for is 3 lakh rupees. Now, in 18 years' time, that 3 lakh is probably compounded to at least 15 lakh rupees. So you have to work backwards and say, okay, this is the current cost of education. This is what the future is going to be looking like. And how do I start investing monthly or annually so that I have a corpus of 15 lakhs in, say, 2040. So that's something that we should look at, because you can't forget about that little worm called inflation, which eats into your resources. Another one is, you have to also continually rebalance and monitor. So we have to review our investment. It's not just that you've taken it and you've forgotten about it and then you just wake up 18 years later, like in an insurance policy. Because sometimes what you receive may not be enough. It is not equal to the purchasing power that you might need at that time. So every 3 years, you need to review how your investment is doing, so that X amount of money, like I said earlier, you're looking at 15 lakhs or 20 lakhs in 2040. Are you on the right track? Will you be actually getting that money then? What are the changes you need to make during that saving period? That is something that you need to keep a track of. So you need to balance and review it, very, very regularly. Also, do you have clear understanding of how much is needed and when that funds will be used? Like I said earlier, you need to know the current cost of that particular goal that you have, whether it is education or marriage. I recently had a 43-year-old investor whose eldest child, he has two daughters, 9 and 5. And so we actually sat down and we said, what is the current cost of the wedding going to be? Because he had a dream that he wanted to give away both his daughters in a very grand way. So we found out what the current cost of that marriage would be. And then we forecasted in 2000, 40, 38, what will that cost be like? And then we started an SIP in order to make sure that he will reach that goal, because he was very clear that both the girls are his princesses, and he wants to make sure that they marry very well. So you have to also know, how your investment is going. Also, don't mix up the funds that you've earmarked, say, for an education and for a marriage. So keep your goals very distinct so that both the goals can be met. Sometimes we just have a big, corpus, and we say, take care, I will manage this also and that also, and also leave estate to the child, or maybe even a plan, foreign holiday for that child. So make sure that whatever your goals are, they're earmarked distinctly, and you're saving individually for all these goals. So
Yeah.
these are some of the mistakes that can be made.
Yeah, honestly, I think that's a very common mistake, that you just create like this entire balloon of funds and then just, keep spending from that. I think you've given some very practical advice that it's good to create individual buckets, and, earmark funds for specific things, because it just helps from an administrative purpose as well, I guess, and you don't really lose track. So savings are done. Parents have started early, and we get a lot of gifts as well in India, right, when the child is born. So all
Right.
of the money has been saved, kept aside. Now, obviously, saving it is not enough, because like you said, inflation is that monster which will eat into all of these savings. So what are the right investment products that these savings should be deployed in?
So typically, you can have a children's oriented mutual fund. So some of the examples are Tata Young Citizens Fund, ICICI Pru Childcare Gift Plan, Aditya Birla Bal Bhavishya Yojana, LIC MF Children's Fund, UTI Children's Fund. So these are, specifically created for parents who don't want to keep on, worrying and sort of deciding where the future is going to be. You just take a prepaid kind of a children's oriented mutual fund, and let that carry on for itself. So some of these funds are typically, a hybrid funds. So they will be investing more in equities when the child is younger and more in debt when the child is older. The good thing is that you can't really redeem from some of these funds. So you continue to invest for the longer period of time, because it's kind of illiquid. You can't redeem before the child is 18. For girl children, we also have the Sukanya Samriddhi account, where you can save for about 10 years, and 11th year also sometimes is possible. You can extend for one more year. And the maximum that the child should be is, so that when the child is of a certain age, say 18, and that is the time that you can withdraw and use these resources. So that's Sukanya Samriddhi. It's run by the government, and it's a very safe, instrument, because obviously it has the government backing. It started in 2015. You can also enjoy tax benefits up to 150,000 rupees. So, they're under the same ATC benefits that we enjoy for other tax planning. So that's something that you can also consider for the girl child. And, so these are some of the broad investments that you can do. You can also create a do-it-yourself mutual fund for your child without going into a prepared plan. So that is something that you and your financial planner will sit down and say, okay, this is the SIP, and that is the amount that I'm going to be very disciplined and very systematic. So here the discipline is upon you, because you have to make sure that you don't redeem. These funds are naturally open-ended and open to redemption also. But if you are the kind of person who's very systematic, very disciplined, and your focus is your child, then you can definitely use a mutual fund. If your term is longer, then you can use a 100% equity fund. If your term is shorter, then maybe you can use a hybrid fund. So make sure that in this all the control will be with you if you create a mutual fund education plan for yourself. But of course, you have to be disciplined and systematic and make sure that you don't stop in between.
Okay, so basically, two options for those parents who want to, have it on an auto mode of sorts. Then there are these children-oriented mutual funds which have this lock-in, so there's automatic discipline. But if you want to go DIY, then you'll have to consider things like time horizon, so on and so forth, and accordingly construct your portfolio. If you have a long-term time horizon, then more equity. But if it's a shorter-term time horizon, then you'll have to ensure you have done your proper asset allocation between equity and debt, because you obviously cannot afford to take more risk if the time horizon is approaching close. So I think maybe then the children oriented mutual funds are a good solution for those parents who really don't have the time or the financial wherewithal to go about doing it yourself. Let's specifically talk about this one product which you briefly alluded to, that's NPS Vatsalya. It's relatively new. That's why it's being talked about a lot. And, Nisreen, if you could share with our viewers a little bit about this product, what exactly is it? What are its advantages, disadvantages, etc.?
Sure. So in the NPS Vatsalya, basically you can start even with a minimum contribution of 1,000 rupees also, and there is no upper limit. So all these contributions get funded through the market associated options, which will allow the funds to continue growing over time. So when the child turns 18, the account will then become transformed automatically into a normal NPS account, which is a pension fund account. And this will let the child take charge of their own savings for their own retirement plans. So, you start much earlier when the child is much younger. So you have already trained the child to start thinking for their own retirement, which is very important, because today we don't have social security and we have to start planning for our own retirement. So the child can also then make contributions to the NPS account independently, and will also get the options to use the funds to buy an annuity for periodic income after they have, retired. So that's, like a really long-term plan, but that's a blessing from the parent. Now, the parents or the guardians can also withdraw from the NPS Vatsalya 3 years after joining. So in case there's an emergency, then you have the option of withdrawing, and you can withdraw about 25% of your contributed amount. Also, the withdrawal option is available only 3 times until the child turns 18, because that is the time that it will vest and the child himself or herself will, take over the pension planning. So basically what the key features are, that there's long-term protection, because the parent has started this strong financial safety net for their child, ensuring long-term financial security. You also have the advantage of investing in market-linked investments. So over here, you can choose a market-linked option, such as a debt fund or an equity, and this will offer the option of giving you a higher return compared to, traditional investment plans like fixed deposits, etc., which may not beat inflation. So here the key word is also that you have to make real, returns over and above inflation. So therefore, you might have to invest in equity-linked investments, but over a period of time, it's very safe, and all the issues will get ironed out if your tenure is longer. In the shorter term, of course, there will be volatility, but since we're talking about a longer term, it's definitely a plan that you can consider. The scheme's main aim is to create a robust retirement fund for your child, leveraging market-linked investments and consistent contributions from your side. It also creates financial responsibility for the child itself, or himself or herself, and it helps the child learn about, money management, retirement savings, and financial responsibility from a younger age. So therefore, it's very interesting. Also, you have flexibility in contributions. So parents can make contributions either as lump sums or regular payments as per their affordability. So it's basically kind of a systematic financial planning, where you can make even a lump sum contribution if you get a bonus, etc., and a monthly kind of an investment or an annual investment as per your own cash flow. You also have flexible payout options. So when the child has become, of the retirement age, they can take some amount as lump sum and some amount as an annuity during their own retirement period. It also has a lifetime, inbuilt life cover. So this scheme includes a life insurance protection for your child's family if something happens to the guardian during the contribution period. So all in all, I think it has various features which encourage financial responsibility and systematic planning for the parent himself or herself, and definitely worth considering NPS Vatsalya.
I think a big chunk of our discussion on financial planning for children, which I've missed out, is actually teaching children also to be financially responsible. Because, while of course we'll do our bit for children and, set aside that nest for them to fall back on during tough periods, the first part of trading, I think, comes is to impart the knowledge that we have to ensure, or at least try to ensure, that these tough periods don't come on them. So, Nasreen, any tips to parents who are trying to teach their children to be financially responsible?
So, when you're giving pocket money to your child, for example, make sure that you've taken the account back. So there has to be some accountability. You start when the child is a bit, is really tiny. And more often than not, we do give some amount of money to our child, either for, a bus ride, transportation, food in the school canteen or cafeteria. So even when the child is young, they can maintain a small logbook of what they have received and how they have spent. So this way, they will, continue to develop financial responsibility, because whatever the difference between what you've given them and what they've spent is for them to save for some purchase that they want to do. So if they want to buy a pair of shoes, say for a particular sport, or they want to buy a T-shirt for a particular, if they're very fond of football and they want to buy some club's T-shirt. So try and make, helping them or encouraging them to buy that out of their own little savings. So you can add on a little bit, of course. I mean, we're not saying that the child shouldn't get what you want them to get, but in this way, the child will develop a sense of respect, independence, and it will really change the way that the child himself or herself thinks about themselves, because it starts creating this financial independence and respect from a very young age. Continue that till when the child is older. You can also encourage dinner table conversations about money. If the parents are going through some financial crisis, I don't think that we should hide it from our children. I think we should be very open about it and say, listen, this is what we're going to be going through this year. We are all, definitely going to be tying up our shoestrings a little bit more. This is the discretionary spending that we are not going to do. We are not going to be able to go out for dinners and lunches. We're going to be watching a lot more videos at home. So these are the things that, you have to tell your child, because you prepare them for their own financial emergencies in future. So, have an open discussion with your children and teach them about savings from a younger age. I think that's the way that, parents should definitely include children also in financial discussions.
That's very true. I think many of us, it's not a common dinner table conversation, right? Money or finance. And I think it's high time that we, normalize it. Talk about money openly to your children. So they also are sensitized to the topic. They're made aware that, there are times when things might get a bit tough. So maybe, you should tighten your purse strings. Very true. Well,
Sure.
okay. Also, we'll be taking on board some viewer questions and queries. Remember, folks, that right here on Daily Finance Wrap, every day, you can post in your questions right there on the YouTube comments section, and we will get our experts to answer them. So I'm just going to go across to our YouTube channel and see some of the questions that we've got. The first question has come in from Ro. He asks, are ETFs better than mutual funds? What's your take, Nisreen?
So definitely, you can consider a diversified, ETF as well. Very similar to how a mutual fund will work. It might be a little more diversified than a mutual fund, in the sense that there will be many more stocks listed in an equity ETF. But definitely, if you have, going for an ETF, it definitely is a low-cost product. It will be listed also on a stock exchange, and you'll be able to see it, with your other investments in a very easy way. So both are equally good. You can go for a mutual fund or an ETF. Both are very good instruments for saving for your child for the longer period of time.
All right. We have another question coming in from Vinith Patel. Vinith is asking, what is the best kind of insurance I can take out for my child? Nisreen?
Sure. So, basically, you don't have to insure the child, you have to insure the parent. So, what I typically suggest to my investors is that you take out a term plan for yourself. God forbid something happens to you, the child's education, also, your EMIs, etc., should not be affected because the children should not be displaced. They should continue in the same, what you have thought for your child, what you have aspired, in the sense that that education fund should be insured. So insure yourself for a term plan, which is a low cost insurance product, which you will pay annually the premium, just like you do for your car. And for that, you calculate your own human life value, which is the contribution that you make to your child's future. Okay. So you plan that, whatever you have planned for the child in terms of education or marriage, that would be the sum assured that you should need. Also, if you have an EMI, then also include that amount, the home value into the sum assured, and then pay your premiums accordingly till you are about 60 or 65 years of age, because that's the time when your child would possibly be very well settled and would not need your insurance policy to pay out for their own education. Along with that, start an SIP either into an ETF or a mutual fund or a children's oriented mutual fund. So the combination of the two would be a much superior product than going in for a child's insurance policy, which is a slightly more expensive way to manage your child's, corpus, whatever you are planning for the child. Because when you go in for these children's education policies, the costing is a bit higher. Plus, the performance may not be as good as going in directly for your own mutual fund and term plan combination. So, I think that that would be very suitable for you.
All right. A very interesting question from Akash Kotian. He says that how should one prepare their portfolio for wealth taxes if and when they do come? And rightly so, Nishrin, they've, for the last 2, 3 budgets, I think this is a question that was always put forward to a lot of personal finance experts. Will she, won't she? So, yeah, in the event, if it does come about, how should parents manage with it?
So see, typically, I mean, we will be looking at wealth tax in future. We will be looking at inheritance taxes in future. So, I think the best way for us is to continue to do what we know best. That is, continue to invest for the children, continue to invest for our own retirement in the way that we have been doing. Because as and when the STAPs come, it's very much like our capital gains. We were paying 10% for long-term capital gains earlier on equity funds, and now we are paying 12.5%. So whatever we owe the government, we will have to give. But that doesn't make any difference or any change to the way that you are investing now, because there is no clarity on how these taxes are going to be charged in future. So right now, just keep on the blinkers and continue to invest. Have different goals, have medium-term goals, have short-term goals, have long-term goals, which will include your children and your own retirement. Because a lot of times we notice that we sacrifice our retirement plans in order to send our children maybe abroad, or we pay very high fees and capitation fees to certain institutes in India itself. So you make sure that you have different buckets of planning and you don't compromise one for the other. As far as the taxes go, whatever will be, but make sure that you are right now on track so that at least your savings are available to you, either to pay the taxes or for the goals that you have set aside for yourself.
There's a saying that there are only two certainties in life, and one is death, one is taxes. So I guess no point worrying about when it comes. I think we'll take on one more question from Charmi Patel. She asks, what about gold ETFs? Is that a good investment?
So gold, typically, don't go in for a gold ETF unless it's more, less, about 5 to 10% of the entire portfolio. But if it's good to have gold, especially in these uncertain times, but you can also go for something like a multi-asset allocation fund, which will include debt, equity, and gold. And the fund manager will decide the proportion of gold into that fund. So, you don't have to keep on taking a call and rebalancing your portfolio, because when you start, you expect that it should be around 5 to 10% of your portfolio. But as you proceed, the percentages might go up. And then the onus will be on you to keep on rebalancing. So I would suggest a multi-asset allocation fund, which will include some amount of commodities like gold and silver, as well as debt and equity. So that way, the fund manager will have the responsibility of asset allocating between all these various products, and it won't come on to you. So definitely, it's a good choice. It's good to have gold and silver in our, commodities in our portfolio, especially now that we're looking at some slightly uncertain times. And even for the long haul, you can definitely have gold. Don't exceed 10% of the portfolio would be my recommendation.
All right. Okay. Multi-asset allocation, the way to go to get some exposure of gold or any precious metal in your portfolio. Well, that brings us to the end of this segment. Nisreen, thank you so much for joining us today on Daily Finance Wrap.
Thank you. It's completely my pleasure, Mabina. I hope the viewers have enjoyed, and also the response to the queries was useful to them. Thank you.
Absolutely. And of course, if you like to get your questions answered, then do drop in comments on the YouTube comments section and we will get them answered. This brings us to the end of today's episode of Daily Finance Wrap. Thank you so much for watching.